in this session, we are going to be discussing our flexible approach to income, assessing allowable income. So here we'll be covering self-employed income, employed income, investment income, and your OpCo, PropCo transactions. And we'll also be giving you some hints and tips to help you to protect you and your business. And then, as I said before, right at the very end, we'll be covering any questions that you have raised throughout the session. So again, please use that chat function because that will help us to get as much value out of this session as possible. So let's get cracking. So first of all, let's talk about our flexible approach to income. Hopefully many of you are fully aware of our level of flexibility that we have when we assess income, that perhaps we can do things that other mainstream lenders can't do. And this is a reason as to why many customers end up working with Together and potentially have been turned down elsewhere. Now, one of these areas is our uncapped loan to income multiplier, because we don't have one. As UK's largest non-bank lender, we're not tied to any income multiple restrictions. So it's strictly on an affordability process only. So if it fits affordability, fantastic, whether or not that's perhaps 7 times their income multiples. We can also base affordability on forecasted income. So say, for example, for a regulated transaction, if they're within 6 months of the next financial year and an accountant can complete an accountant's reference and provide us with that forecasted income, we can base affordability off 100% of that figure. We can also, for our unregulated transaction, base affordability on projected income. So a customer does not need to be trading for 12 months, for example, for unregulated transactions. It could be a new startup business that they're looking to do. And as long as it makes sense, we can utilize projected income. And there's different affordability assessments, but in most scenarios, we'll utilize 90% of the projected income. We can also consider top slicing for your buy-to-lets, but that's for the right transaction to the right customer. So we do make sure that, especially given the current market conditions, that we don't want to put anybody in any undue distress with their monthly income outgoings. However, we are accepting top slicing for certain scenarios. That criteria is available on our product plans. And then, as I mentioned before, we don't do we don't do the LTI calculations. There's no restrictions. It's purely based on affordability. So this also looks at declared affordability. So we also refer to that as stated affordability. So the actual outgoings that the customer is paying, because they may be less than what the ONS figures tell us. So on our automated affordability assessment, there's an element of ONS in addition to our own model, but there is the option that if the customer fails that for either their top slicing transactions or the residential regulated transactions, we can then look at customer stated. There's other things that we can consider as well, and this is probably a key area that customers transact with us, is our ability to use many different types of income. So Emma's going to be talking on this regarding our regulated transactions, the benefit income that we can accept. We can accept pensions and second jobs. So for second jobs, we can consider 100% of that income, which is great because this, in this current market, many customers are having to take second jobs, but we don't restrict to say 50% of that income that some of the lenders do. Then we also have a simplistic calculation when we look at affordability for holiday lets and commercial properties. So say, for example, if it's a commercial investment transaction, however, the ICR coverage doesn't meet at 120%, we can then look at using other income in the background. So it's not just purely based on the income that's generated by the security. We can look at other income that the customer has got in the background, and then how we assess that as we look at the percentage, the ratio of what their total secured debt is to their income. Then there's another thing that's a key USP of ours is that we can accept applications where we're utilising income from multiple applicants who may not be on the title deeds. So say, for example, you could be looking at doing a refinance application or a second charge application, and you need to utilise some income perhaps from a family member. As long as they're happy to be part of that application, we can process and we do our affordability assessment factoring in 100% of their income. We will need to consider any other expenditure that they may have in the background, including their own residential expenses there in the background. So that's our flexible approach to income. Now I'm going to pass you over to our lovely underwriting team across our personal finance and our commercial finance team. So Emma Barker, Bradley Wolstenholme and David Spruce. And they're going to go through some hints and tips with you to support you with getting the affordability assessment right first time to enable speedier funding solutions. So over to Emma.
Thanks, Michelle. So the main thing I wanted to talk about today is the main employment from customers and what income we can use when we're looking at overtime, commission, other factors that make up pay slips that I don't think it's very clear that we explain what we can use. So when we're reviewing the amount of earned income we can use, we'll consider an average of the pay slips received compared to the year-to-date calculation on said pay slip. So the system, you've probably seen it yourself, the system will ask you for 3 pay slips and will also ask you for the year-to-date information. And at that point, it calculates both and then figures out if it's comfortable with what we're using and flags it internally on submission. So what this little part of the session is to show you is what we will consider using across the board and what we also won't consider using in term. So in terms of what we will accept regular commission on the basis that it is received on every payslip we received on a similar amount. So if it fluctuates and they get a little amount one month and a lot the month after, we'll have to take a common sense approach to how much we'll use for all 3. Weekly, fortnightly and monthly bonuses. So again, as long as it's showing on every payslip, we will consider using it as long as the amount is similar across all of them. Location allowance tends to be the same no matter what the payslip is, so that's acceptable in all cases, as is regular overtime on the basis that it's the same amount across every payslip. If we see some fluctuations, if the customer has an extra £1,000 one month and then £100 the month after, we'll calculate the year to date to see what it looks like across the year to make sure we're protecting the customer in terms of how much income we're using. And finally, car allowance. We do accept car allowance without any further question, as long as it's the same on every single payslip and it's not temporary. As long as we know it's forever and we can see it on all the payslips, we do accept that. So now moving on to what we don't accept. This falls back on making sure that we're protecting the customer across 12 months of payments. So accepting a bonus that's not regular, a commission that's not regular as a monthly income, we know that in some months the customer may not be able to afford our payments. So we have to take into consideration a regular amount that is received. So sporadic commission, received one month, not received the month after, it's unlikely we'll use that as a regular income. We can take a view across the year on how much they earn, again, looking at the year-to-date figures. But in terms of using a high amount every month when it's clear they don't earn it, we won't accept that. Irregular or seasonal overtime, so customers that have more income during the summer holidays or maybe over Christmas, we wouldn't be able to use that as a regular monthly income. Cost of living payments tend to be one-off that we're seeing at the moment, so obviously that wouldn't be received every month, would have to be discounted from the income that you're using on the system. Quarterly, half-yearly and annual bonuses, again, we've made the decision not to accept those at the moment, where we can only accept a monthly income, or a monthly bonus, should I say. Sign-on bonuses, again, it's not a regular income, so we wouldn't be able to accept that on a regular basis. Secondment allowance is temporary, so the customers will probably receive it for 6 to 12 months. After that would go back to their basic pay as far as we're concerned, so we would have to use the basic pay. And holiday pay is payment for holidays not taken, usually, so wouldn't be a regular income going forward. And finally, I just wanted to discuss our new accountant certificate for those who haven't seen it. So we've made some changes following feedback we've received from accountants, brokers in the industry, who said that our original accountant certificate didn't have enough information for accountants to be able to give us all the information we needed for customers that weren't limited companies. So what we've decided to do is create a certificate the same across personal finance and commercial finance, allowing it easier for everybody to know how to complete it. So firstly, you'll see we've got the limited company information that remains exactly the same as it always has done. We've got figures from 2 years ago, last year, this year to date, and then this year's projection. So ideally, we need 3 years figures in total, with this year's projection being the end of the next business year. So if, for example, the year end was April, in your 2 year ago box, you'd have April 22. Last year, you would have April 23 because it's the last business year. This year to date would be April 23 to the end of September. And then this year projection is this business year, which would take you to April 2024. And as Michelle explained earlier, as long as our projected figures are dated within 6 months, we will use the projection, 100% of that projection. So the limited company information has remained pretty much the same. We've added sole trader and partnership. The same year-to-date information applies. We just now have added the total net profit for the customer after tax and national insurance. The reason we've done this is to try and reduce the amount of phone calls we're making to accountants, and then hopefully the underwriters can just tick off they've got the right information and move on. As you can see at the bottom, we've added net rental income for all those portfolio landlords that have got lots and lots of buy-to-let properties, or even your customers that have only got one. So we've added in, I'm not sure if it's clear to see there, we require net rental income after tax, national insurance, mortgage payments, and any other associated costs. So what this allows us to do is, once that's completed, is completely ignore any other buy-to-let mortgages on the credit report. And then finally at the bottom is total net income, which is net of all of the above boxes. The main addition that we've made to this is a change to our accepting the Association of Accounting Technicians. So if we have an accountant that is AAT, MAAT or FMAAT, we can only accept them if, one, they have a practicing certificate currently, and two, they're part of a larger firm that has one of the other qualifications. So if we receive an AAT qualified accountant certificate, but they're an independent accountant and don't work as part of a larger firm, we wouldn't be able to accept the certificate. We would need an accountant to be part of a larger firm that has one of the other qualifications. I hope that all makes sense. That's a lot of information in a short space of time.
Thank you, Emma. So another form of income we can accept as an alternative to accountant certificates is self-assessments, also referred to as tax year calculations and tax year overviews. So we can use self-assessments to support affordability for self-employed applicants, alternatively for applicants with multiple sources of income. So, for example, if they have rental income from buy-to-let properties, or if they also take dividends from other shareholdings they have. So what we've done is just broken down the requirements for Together Commercial Finance and Together Personal Finance. So in commercial, we require the latest year's tax year calculation, along with the corresponding tax year overview. For personal, it is the latest and also the previous years. And again, it is the corresponding tax year overviews. In Together Personal Finance, we do also require the last 3 months business bank statements. So with all our applications on self-assessments, we do use the net income figure. So obviously this is calculated by deducting the tax paid from the total annual income received. Now, a change we've made in the last probably 12 months, if the applicant does have income from UK land and property, we will need an accountant certificate in order to deduct any existing mortgage payments from affordability. So we do have quite a lot of scenarios on buy-to-let applications, for example, where we're looking to, or the applicant is looking to have the existing secured payments ignored from the affordability. We will need an accountant to confirm the net rental income in those scenarios, rather than just relying on the self-assessment. So another form of income we use is lease agreements and ASTs. So the reason we wanted to cover this really, certainly I feel this can be the most simple way to evidence affordability for a lot of our applications. So when lease agreements and ASTs are in place, we'll look to use this income to support affordability. Now we can do this on multiple types of security, commercial, semi-commercial, and obviously your buy-to-let properties. So for example, on a semi-commercial, if there is a occupational lease in place and also an AST for a flat above, for example, we will use the income from both of those. Now, where there is a AST and a lease active and already in place, we will use up to 100%, or we will use 100% of that income. We can also use 100% where solicitors are going to confirm that that lease will be in place on completion. So a lease may be being drawn up during the application process. As long as we get that confirmation in the report on title from solicitors that that is now in place and signed, we'll use 100% of that income. Now, if there's no agreement in place during the time at the time of completion, we can also look to support affordability using projections. That is both on commercial occupational leases and also projected rent on buy-to-lets. Now, in these scenarios, we use 90% of the projected income. Now, the rental projections we receive, those can be from valuers on the valuation report. We can also accept rental appraisals from estate agents. We can also look at comparable properties in the area. So we can take a look at Rightmove, for example, check rental comparisons in the area. And if we're happy with those, we'd use 90% of that projected income. On the buy-to-let and consumer buy-to-let applications, our system, MyBrokerVenue, will automatically calculate where further income is required. So you'll input the rental income. Our system will compare that against our mortgage payment. And if a full affordability assessment is required, it will direct you to that. As Michelle mentioned earlier, we do have our top slicing criteria. So that is available on our product guide for those instances. For our serviced unregulated bridging and also our commercial term applications, we can use the lease and AST income as a sole source of income to evidence affordability. Now, that's if it covers our mortgage repayment at 120% or more. So that's certainly, I say, it can be a real simple way to evidence affordability, as we won't look at any background secured debt if the income solely from that security covers our stressed mortgage repayment at 120% or more. We do have our stress test calculator where you can input the rental income and that will confirm for you whether the application is affordable or whether we need further income. So something else we also wanted to cover was OpCo, PropCo scenarios. The way we assess income on those is slightly different compared to when there's a standard lease in place on a property. So just to recap on what an OpCo, PropCo is and what we're referring to. So this is a scenario where a business will set up another company, which is the property company or the PropCo, to hold or manage the property. The properties are then often leased back to the original business, which is the OpCo, the operating company, from the PropCo company. So for affordability in this scenario, we'll be looking to do our total secured debt to income or TSDI calculation. So where the companies have been trading for 2 years and we can see the evidence of the lease income being paid, we will be able to include that income within our TSDI calculation. We can then also use, obviously, the other income from the company evidenced by an accountant certificate or income from the directors evidenced by self-assessment, for example, in order to calculate the TSDI. We do also have instances where there are leases in place to connected parties. So, for example, a lease may be in place to a family member's business or to a partner's business. In those instances, again, we would want to calculate TSDI rather than just relying on the lease income.
Thank you to our underwriting team for covering those areas. And just a reminder, if you do have any questions regarding allowable income, even if it's something that perhaps we haven't covered on this morning's session, please raise it in the chat box, because this is an opportunity for you to get as much value out of this session as possible and for us to cover those questions at the end of the session. What I wanted to kind of cover is that from the regulated perspective, over 65% of the business that we do is for self-employed applicants, and that's because of the flexibility that we take with assessing the self-employed. A fair lot of those applications that work with us is on the basis that we're using the forecasted income. So that just shows, you know, a good chunk where some of these customers have been let down by the high street. We are here to provide them with their funding solutions that they need. Also, we continue to trade very well on a commercial term. So we've talked about some of these transactions and how we assess our affordability, the simplistic approach to assessing income in the background, that we can use more than just the income that's coming from an investment property. We're there to support with startup businesses, for example, or customers who perhaps haven't got a full year or 2 years of trading of accounts. And again, they may have been turned down by somewhere else. And it's our flexible approach, and we want to work with you on these transactions to provide funding solutions for customers' property aspirations. So again, thank you to our underwriting team. I'm now going to pass you on to Molly Dobson, who's one of our financial crime managers. Molly is going to talk through some hints and tips really to help you to identify some red flags when assessing income proof. And this part is just our ongoing support with yourselves to help protect you and your business. So over to Molly.
Hi, and thank you, Michelle, and hi, everyone. So similar to what Michelle said, is that I'm just here to kind of give a little bit of an overview, some hints and tips, and kind of give some guidance, and also give you an insight into what we would look at to say, for example, if our team was to look at any of the income. So I think it's safe to say that at the moment, due to the current economic climate, we are seeing a lot of constraints for individuals, as we've talked before, in regards to secondary income and looking to the different avenues of what more income can be used. I think it's really good that is a unique selling point for what we can offer. And I know that in the past 2 years, maybe more the past year, my department and the financial crime team have kind of collaborated with working with the wider business, that we can help on these case by case and the common sense lending and make those assessments. Because I'm sure you're all aware, with mortgage fraud, there's two types, and there's fraud for profit and fraud for property. The fraud for profit is probably the hardest one to commit, because of obviously there's quite a lot of people that need to be involved in it. Solicitors, there might not be a real person, but it's the one where it's the fraud for property, which is where individuals tend to tell those white lies, sort of fabricate income, potentially tell those lies that they think that they can have the loan. And it's about knowing those signs and see what you can look out for. So I've just included 4 of the boxes here, and these are just the things that we would consider. So first of all, whenever we get any income, I would ask yourself, is this plausible? Now, I know that you might be sat there thinking, I'm not really sure, but it could be is that you're looking at the customer profile. So for example, their job role and position. It's unlikely that someone below the age of 20 would have a very senior position. It's not impossible, but it is just not that plausible that you would think. For myself as a manager, and you come into your own roles, the jobs that everybody has on here, it's quite difficult to get into the position. So would someone with a lack of experience? It could even be that if you were unemployed and then you walk straight into a management role, how has that happened? Could you ask the question? It could be that you ask the question and the person says, yeah, I know I'm 20, but I work for my dad's business. I have done since I was 14, and it's just kind of evolved in that I have this title, but it's only a small restaurant, and that's why I'm a restaurant manager. That's plausible. It's about having the confidence to ask that question. Same with a secondary source of income is if you've seen it and you think, I'm not quite sure how they could manage the two together, just ask the question. Because when someone has a secondary source of income, there's people on my team that have a second job. I know that if you're a tradesperson, you could be employed in the day, self-employed at the weekends and the evening. You could be a hairdresser in the week and a hairdresser at the weekend. It's more when you've got to think about if you were a carer who worked obviously so hard for 50 hours of the week, but then you were self-employed for 30 hours as well. Where's this 80 hours of work coming for? Is that the plausibility for it? And again, similarly with the salary, if you were to look at a restaurant manager of a takeaway shop and they were on £75,000 a year, it's just about asking those questions and how you got into it. It really feeds into when you have the KYC. So KYC isn't always about get a passport and a proof of address and that we've sorted it. It's about knowing your customer. So exploring in the plausibility and asking those questions can really help you know that customer, and it can also preempt what could happen further down the line. So say you did get challenged or we did ask a question, you can confidently turn around and say, I know this customer, I know it's absolutely fine. Or it can help you basically before you even get to the point of submission to say, no, this is not going to work out. So that leads on to once you've kind of done the plausibility and you think, okay, this is fine, I'd look at how the income can be validated. So standard, we would accept the documents that Bradley and Emma have gone through in regards to pay slips. You could look at SA 302s, accounting certificates. But I suppose there's limitations of when they can't be evidenced. So say, for example, if they're paid in cash, how are we going to be able to validate what they're saying? So cash is just a high-risk transaction. Could you get an employer's reference? Could you do any checks that we could, or get that information? I've put bank statements first because I'm a big advocate that bank statements don't lie. And I believe in this through and through. So if you've ever been asked for bank statements from Together, it's probably because of me, because I might be looking at it. But I think that they can give a really good oversight. They can show the salary transactions, but they can also give an indication of how they operate from an affordability point of view. It could also help you with deposits because you can see the balance. But I just would like to share a story where I think it would be, and I just want to clarify, this was not at Together, but it was another institution. A bank statement had transactions on it, and it was to myfakepayslip.com, which is exactly what you think it's going to be. It's a website where you can make a joke payslip to fool your friends. I mean, I'm not only sure the joke, but it's just those things is that the bank statement can't lie. So the salary credit wasn't there, and there was a transaction to evidence of why it wasn't there. So that's if you ever get anything, 3 months bank statements will help you. That can then lead into when you've got your self-funding and your buy-to-lets, because I know that it's a lot difficult when you are self-employed in regards to a bank statement, because you don't get that salary credit that everybody else does. You kind of have more sporadic payments, you're paying for transactions. So it's about how we're going to be able to evidence that as well. So the reason why I've put this the rental income plausible, I think that's just for your comparables. Is there any reason why they're sort of fabricating the rental income to help for affordability? But I've also put in there that when the AST was signed, so in this scenario where we are using an AST for evidence, what we would look at there is if they're saying they cannot support income, have a look at when it was signed, because that will indicate how correct that is. So for example, if the AST was signed from September 2023 and was a years long contract, it won't be on an SA 302. But if it was September 2020 on a 6-month rolling contract, I would expect to see that on an SA 302, or at least be declared at some point. I've then included a section about errors. Now, I know this is really hard because I know that you probably don't look into this much detail, so I completely understand, but these are just a lot more hints and tips. When I've put the format of the document, now I know you probably don't know what every single payslip looks like, but you can have a general gist. So for example, I know what an NHS payslip looks like because they're quite common. I know that with more of your larger institutions, you would expect to see a finished payslip. If you are, for example, a Together payslip wouldn't just be a piece of paper with kind of this is your salary and this is your year to date. So have a look at those to see whether the type of payslip would match up with the business size. Again, spelling and punctuation is a massive thing because that just wouldn't happen on a corporate payslip. So for example, if there's a comma instead of a full stop, they've spelled pension wrong, for example, that's a massive indication. Could also show that it's been edited. And the figures, do they add up? in actual fact, that could help you link in to Emma's part in, so if you had a look at the figures and there was a year to date, it may possibly be that they've got a bonus that we could also factor in potentially if there was enough evidence. And the employee number, this is often a massive giveaway. So if you work for a big company and you've got an employee number of 2 and the company's got 1,000 staff, you would have had to have been the second person to have employed. So I'm a big advocate for looking at those ones. So I've just got another slide for you, which is just the main hints and tips of the red flags, and a little bit at the top there that just talks about the reasonable person test. Now, what I mean by that is if you take yourself out of the situation, so with none of the experience that you all have, and if you were to just ask someone, if this scenario, or you heard it, would you think it was unusual? So if you were to just tell a random person on the street, I've got a person who's 19, is a restaurant manager earning £75,000. Does that make sense to you? Would you think that would be okay? And at that point, if you're doubting yourself, that's when I'd start to ask the questions, know your customer, and maybe ask for further evidence, ask for more payslips, ask for bank statements. So I've just summarised in the bullet points the main things that we would look for and the main things that I think that would be really useful for you all. So the spelling mistakes, does it look right? Sometimes it can be slanted and sometimes that can be because of the way it's been copied. But just have a look at how the format is. If it's been copied and the boxes are misaligned, that's normally a red flag. Again, the size of the business, how long has it been incorporated in regards to the roles, how long they've worked for. One of the main ones that I will focus on as well is that, is there any adverse media on the client? Now, it's a 50-50 on this one because I know that no one, well, some of them do, but a client's never going to come to you and say, just to let you know, I've been declined before because I've provided some false documents, but other than that, what I'm providing with you is correct today. Or they're not going to come to you and say, look, I'm really sorry, I've just come out of prison. Is this going to be okay? Sometimes a simple adverse search could be just a Google search or an open source search of the individual, just kind of get a feel for them. It could also give you an indication. Again, it's not about income, but just about status in regards to like PEPs or high risk. There is searches that we'll do on our side, which we wouldn't be able to share. But I think if you've managed to get quite far along the process with no concerns, it's unlikely that you're going to get something off the back of that's hidden away. Another thing is reluctance to provide information is going to make us even more suspicious. I think that if you are a genuine person and you've got a genuine explanation, you would have no hesitation to give that information away, provide the bank statements. Similarly, if they've avoided answering any of your questions and want to answer only 1 and 2 and leave out 3, that to me would be thinking that they don't want to answer.
Thank you for that, Molly. Now we've had, for those of you that joined us in our last session, we had Rachel from Financial Crime with us, and obviously Molly's joined us today also from Financial Crime. What this does show you is we've got in sales, so I'm in the sales team, we've got a very strong relationship with our teams in Financial Crime and our compliance teams. And what I wanted to share with you is that, you know, that any dialogue is open between us, as in if you've got a concern with something. So thanks to the hints and tips shared by Molly there. If you've got a concern with something, please don't hesitate to get in touch with your account manager, because your account manager will then work with Molly and her team to have a look at something. We'd rather work with you and look at something in advance of you submitting something through, and then perhaps finding out something later down the line that we're not comfortable. So this is to help save you time, and also again to help protect your business as well. So fantastic relationship that we've got with that team. So really appreciate your time, because I don't think it's usual in this industry that financial crime teams get onto webinars with our broker partners. So we really appreciate that. And when we were talking about all of the income proof, the allowable income proof that Emma was talking about earlier on today, if you have got something that seems really out there, a bit quirky, please just refer it through, because we do have a flexible approach that if it makes sense to us and we can accept something that's not the norm. So we've got our underwriting guide on our Chalk Talk section of the website. But if there's something that the customer is in receipt of and it's not in there, doesn't mean that we won't accept it. So using the referral process on My Broker Venue, please raise any questions that you might have with something non-standard. but upload a copy of the document, because that will help our underwriting team to review it and make a decision if it's something that we can accept that income. Again, we're here to work with you and support you on cases, because we continue to find that more and more customers are falling into the non-standard specialist market, and with our flexible approach to income proof, affordability, it's an area that's a growing area that we can support with here together. So thank you everyone for going through your sessions. So now what we're going to do is go through some of the questions that's been raised. Now, what I would like to just reiterate, even as we're talking about this stuff, if you've got a question, please raise it in the chat box. If anything's made you scratch your head whilst you've been transacting with Together, please raise it in the box. We've got fantastic experts on the call today, so now's the time to raise the questions that you've got in regards to income, and we can cover them off today. So the first question that we have in the inbox is in reference to using partners' income. Will the liability show on their credit file? How will they be tied in? So I presume this is in relation to perhaps utilising other people on the affordability assessment that might not be on the application, or it might perhaps be using a partnership, so another director, another partner utilising their income. And the question is regarding the credit file, how will we understand the expenditure, I suppose, in the background? So Emma, can I go to you with that question, please?
Sorry, Michelle, I lost my speakers for a second there. I nearly had to log out. Could you repeat the question?
Yes, certainly. So in reference to using partners' income, will the liability show on their credit file, and how will they be tied in? So I presume this is, as I mentioned, using income from somebody else who may not be on the same security, utilising other people's income in the transaction.
Yeah, so if we were to use a partner's income, they would effectively be a co-borrower. So we don't do like a guarantor status or just use somebody's income from a regulated perspective to support an application without them being 100% liable for the payment. So they would come onto the application as a co-borrower, but in turn it would show on their credit profile that they'd taken out the loan. Does that make sense? So it would effectively be a joint application with the partner.
And there's Dan, there's an expansion on that question from another one of our partners. Expanding on Stephen's question above, so I'm going to stick with you, Anne. If we're using a family member's income for affordability purposes on a second charge, for instance, but they live at another address, how would this appear on the family member's credit report? Also, as they'd be an applicant, because they'd be an applicant on the loan, but it perhaps shows an entry on a linked address. So I presume if they're then applying for their own credit somewhere else, but they're party to a mortgage application with ourselves, I presume it would show on the credit report, and perhaps would affect
the minute that somebody joins our application to support the income, they become a co-borrower. So effectively, our application is also their loan. So I would assume, you'd have to check with the credit reference agencies, but I would assume it'd come up as a linked address, linked borrower, associate across all levels of the credit report. But the loan itself or the mortgage itself would show under the partner's credit profile. In addition to that, I think you've asked about the expenditure. Have I missed that one? Just if they're living at a different address, then we would need the expenditure for both properties to be included in our affordability. So ultimately, they are jointly liable for the 100% of the payments.
Lovely. Thank you, Emma. Right. So a question, do you accept plausible explanations regarding rental income increasing if it's quite a bit more in the projected box versus the previous year? So client has changed two flats into 4 flats, and so double the rental income. So David, can I come to you to that one?
Thanks on plausibility, but then there may be other questions we may want to ask. So if we've not had a valuation done and it's not been submitted yet, you might want to be saying, make sure the surveyor is going into the property to make sure that it's all been done with the correct building regs and permissions. So we can look to use it. If you're using estimated from the valuation, I would imagine that they've already been to the property. So we'd be looking at the comments. One of the key things when reviewing an application is not just looking at the figures, looking at the commentary to see if there's any additional reports or anything that's been raised by a surveyor. So I'd say that would be key in terms of the plausibility.
Fab, thank you. So whilst we have a very flexible home track, so AVM criteria for our buy-to-let transactions, if a property has been converted into something else since it was purchased, so say Zoopla, Rightmove may show it as 2 flats, but then or a 2-bedroom, 3-bedroom HMO, whatever, and then they've since then expanded to 6 or 10 bedroom HMO, small bedroom, so as long as it meets regulation, it's fine. Then what we would need to see is actually a full valuation since that conversion, because we just need to validate that, you know, obviously the right building regulations have been in place if needed, but also to make sure that we are assessing the affordability in line with the number of occupants and potential income that's coming out of that property. Another question. So if a client is purchasing a retail unit in a flood risk zone 3, what would the max LTV be? Also, if there are 3 units and a bungalow on the site they want to rent out, but run the retail unit as their business, so surf shop, we've got an actual case criteria, I think, here. Will you take a hybrid view on accountants' projections made for rent business? She's made good profit in 6 months whilst renting the unit. And would this be in a commercial loan product? So let's split this out. I'll do the second half, but the first half question, client purchasing a retail unit in a flood risk zone, what would the max LTV be? Now we are going to need a full valuation on that one, but over to you, Bradley. What would your thoughts be on the LTV for this?
Yeah. Insurance and the covering of flooding, and whether that's available on sort of standard terms in the market. I
think she is coming still.
We'd expect, say, a full valuation, and then we'd probably refer to the valuer in that scenario. So, as I say, if buildings insurance is available, we'd look at the sort of cost of that, and if it is on more expensive terms than normal, we'd refer to the valuer. They would likely maybe reduce the valuation in that case. In terms of a specific LTV, if a value has reduced the valuation, we may not reduce our percentage LTV because the value has already taken that into account. I say it's one we'd have to review on sort of a case-by-case basis.
Yeah, but yeah, as you say, with that type of property, they've already would have likely factored in the potential flood risk in the valuation for the security, so we're not going to double count that again by reducing our LTV. But different asset types, there's different appetite for ourselves depending on what the asset type is, so please always get in touch with our telephony team for support with that, or your account manager for support with that, and they can give you guidance on our maximum LTVs. But it's not going to be further restrictive, but obviously we need to review the insurance as a first port of call, so share that with us at your earliest opportunity. Second part of the question regarding I guess a mixed use site, so we've got part of it is a surf shop, the rest is a bungalow on the site. Now this will, because of the commercial element on the security, we'll assess this as a commercial transaction, so it'll be a commercial term product with ourselves. And regarding affordability, because again there's a mix, we've got rental income there, we've got trading income there, because you said that they've got 6 months trading, 6 months renting the unit. It's likely that we'll potentially look at a TSDI calculation. So either we can see if it fits on just rental income alone from that security, so the residential rental, the commercial rental. If that doesn't fit, then we can revert to our simplistic total secured debt to income ratio calculation. Now, regarding that particular calculator and support around that, you can find some guidance on that again on the Chalk Talk section of our website. But if you need support, that's what we're here for. And we're always happy to work through an affordability assessment with you if you need that extra guidance. Next question, what's your current appetite on lending to overseas borrower using overseas income? Actually, that was a session that we did in August. So we have got the video on that and on our Chalk Talk section of the website for overseas nationals. But David, you were on the webinar last time round. So care to take that question, please?
Everybody. Yeah, so again, it's going to be a case-by-case basis. It depends where the income's coming from. We may ask for things like contracts if they're employed and recent pay slips. We can do them, we have done them, but it is case-by-case. I wouldn't be able to just give a definitive answer, but if you've got a good case that you think, you know, this one makes sense, then together as the common sense lender in the market, I'd say you'd be coming to us. So give us a shout and we'll be more than happy to help.
Thank you. Yes, we have a very flexible approach when it comes to overseas nationals, including those perhaps that may be in a very high risk country. They may be residing there, or their nationality could be from a high risk country. We look at every case on its individual merits. So again, please get in contact with the team and they can support you with those inquiries. So our telephony team, just for your awareness, we have a fab team up in Cheadle. They can be reached on 0161 933 7101. You can contact them Monday to Friday, 9 to 5:30, and they're there to support you with any new business inquiries.